Economic cost incorporates both visible expenses known as explicit cost and less apparent opportunity cost. These all encompassing cost accounts for the gains and losses in terms of money, time, and resources, offering a holistic view of the consequences of our choices. Consider the familiar saying, time is money. When we decide to dine at a restaurant, we pay not only for the meal itself, the explicit cost, but also for an alternative choices we forego, such as cooking at home or opting for a quick drive-through meal. The opportunity cost comes. To calculate economic cost, one simply needs to compare the chosen economic activity with an alternative. A classic illustration of these concepts involves the trade-off between guns and butter, where we evaluate the allocation of resources to defense spending versus social spending. To produce a certain quantity of guns, we must sacrifice a corresponding amount of butter production. And the disparity in value represents the economic cost incurred in favor of gun production. Understanding economic cost. In the next few minutes, we will explore the critical role economic cost to play in a project management, a cost analysis, and financial decision making. From the impact of globalization to the intricacies of taxation and inflation, we will unravel the complex world of economics cost in a simple terms. So, let us embark on this enlightening journey together and gain a deeper understanding of the forces that shape our financial landscapes. The art is not making money, but it is how we are going to keep it. A very famous proverb. The value. In the evaluation of economic system, we journey from the simplicity of barter system, where goods and services exchange value directly, to the sophistication of modern economics, where money acts as the intermediary. This transition mirrors the fundamental vision of science and technology, the relentless pursuit of a better life by conquering the constraints of time and space. In essence, it underscores a universal law. Anything created by one human being becomes a potential exchange of value of another. Significance of economic cost. Economic costs are of a paramount importance for a professional known as cost engineers and managers. These individuals play a pivotal role in ensuring that various projects, whether they are funded by public or private entities, proceed in a financially sensible manner. The core principle here in any the project, no matter it's in the nature, but make economic sense to be very visible. This concept does not just apply to projects, it extends to the production of goodwill as well. Funding projects. In the realm of economics, projects are the lifeblood of progress. Be in a public infrastructure venture or a private business expansion, the ability to secure funding is a fundamental prerequisite for turning ideas into reality. Without the necessary financial resources, even the most visionary projects remain mere concepts, right? Applicability to production. The concept of economic sense extends its reach to the world of production, manufacturing goods from everyday consumer products to complex industrial machineries, demands a careful consideration of economics cost. Whether it is choosing the most cost-effective material or optimizing production process, economic logic underpins every decision. Now, global challenges. Complexity of economic cost. In the age of globalization, economic costs become increasingly intricate. This complexity arises from involvement of multiple countries in the production of various components used in products. As supply chains stretch across the borders, cost engineers grapple with the challenge of navigating this multi-faced landscape. Decision making. Within the complex globalized environment, cost engineers find themselves at the forefront of decision making. These professionals are tasked with making choices that not only optimize cost, but also align with broader strategic goals of the projects or a business they oversee. Remember, the lack of money is the root of all evil, which is Mark Twain's very famous statement. This quote highlights the significance of financial considerations, echoing the importance of economic cost in decision making. Impact of decision making. The quality matters. The quality of decision making is a linchpin of economic cost analysis. It directly shapes the outcomes of the projects and the financial endeavors. In essence, the better decisions made in this domain, the more favorable the rules. Rational decision making. Making rational choices in the realm of economic cost necessitates an understanding of the intricate web of factors that influence cost. By recognizing how various elements impact economic cost, cost engineers can make informed and logical decisions. Now, elements beyond control. The external factors. While cost engineers wield significant influence over cost-related decisions, it is essential to acknowledge that certain elements are beyond their control. These external factors include taxation policies set by the governments, currency fluctuations driven by global events, and aspects of inflation influenced by the governmental actions. The government actions. Government actions possess the potential to exert substantial influence over economic cost. For instance, changes in taxation policies can directly impact the financial bottom line of the business. While the governmental actions affecting inflations can ripple through the economy, affecting cost in various levels. Charles A. Zaffit says, "It is not your salary that makes you rich. It is your spending habits." This quote emphasizes the relationship between financial decisions, spending, and long-term economics outcomes, reflecting the context focus on rational choices. Key economic cost concepts. The opportunity cost. Opportunity cost stands as a fundamental concept in the realm of economics. It encapsulates that the idea that when options is chosen over another, the potential benefit associated with the unchosen alternatives are forfeited. In essence, economic decisions entail not just accessing immediate cost, but also considering what might have been gained through alternative choices. Now, sunk cost. Sunk costs are financial outlays that have already been incurred due to past decisions, and it has been accrued in the system. Importantly, these costs should not influence on the current decisions-making process. They are akin to expenditures that exist in the rearview mirror and should not cloud the forward-looking perspective. Book cost. Book cost represents the recorded value of assets on the company's financial books, the ledger or financial documents. They are calculated by subtracting depreciation from original cost of assets. However, it is crucial to note that book costs do not correspond to the actual cash flows and are considered in specific situations rather than being universally applicable. The incremental cost. In economic analysis, the focus is often on incremental cost. These are all the cost differences between alternative choices. For instance, when comparing different prices of equipment or of a project, attention is given to the difference in their cost rather than their absolute values. Economic cost changes. Factors driving change. There are different economic factors here. Economics cost can fluctuate for various reasons within the economy. The primary drivers of these changes include inflation, a general price increase, deflation, a general price decrease, escalation, addressing price changes during contracts, and the currency variation, currently exchange rate fluctuations, they call it as. These changes are typically measured using price indexes. This is what the price indexes we are using in the various places. Even for the claims also we are using the price index. Now, it's worth noting that these indexes may not always provide a precise reflection of price change in a specific context. The lack of money is no obstacle. The lack of an idea is an obstacle. Ken Houtaka. The importance of sound ideas and decision making. This quote aligns with the notion that economic costs extended beyond monetary transaction and its benefits. Price level increase. Inflation is characterized by continuous rise in the overall price level of goods and services within an economy. Several factors contribute to inflation, including changes in the money supply, shifts in exchange rates, demand pull inflation, resulting from excessive money chasing limited goods, and cost push inflation, arising when increased production costs lead to higher prices. The deflation, price level increase. Deflation represents the opposite of inflation. This is just opposite. It occurs when this is a sustained decrease in the general price level for goods and services or a representative basket of these items. Factors contributing to deflation can include a contracting money and their supply and rising exchange rates. Because different countries have the different exchange rates. And once you are entering into the projects, especially the EPC type of projects, there are material incoming from various sources and various countries, which reduce the exchange rate, will reduce the cost of imported goods. Escalation, managing price changes. Escalation is a strategy employed to manage the account for price changes during the duration of the contract. This strategy is particularly valuable in providing protection against unpredictable cost fluctuations, thereby offering stability and predictability in financial planning. Currency variation. There are two huge elements has been figured out here: impact on multinational organizations and protecting against variations. Now we can see impact on multinational organizations. Currency fluctuations have far-reaching effects. impacting both domestic and international costs. This is particularly pertinent for the multinational organizations operating across the borders, as these fluctuations can significantly influence earnings and financial performance. Now, protecting against variations. To safeguard against the adverse effects of currency variations, organizations employ strategies like currency future hedging. By doing so, they seek to mitigate the risk associated with the currency exchange rate fluctuations. Currency exchanges leads to strategy. I mean, there are two types of concept we are seeing that. Risk of loss or currency fluctuation impact. Vice versa, reduction or minimize. And coming to the currency hedges in the other way, forward contracts, currency options, natural hedging. There are different strategies as defined here. Now, governmental cost impacts. The direct and indirect influences. Government can exert both direct and indirect influences on economic cost. One of the primary ways they do is taxation and its policies and the imposition of various taxes. These can include income taxes, property tax, excise duty, GST, value-added tax, custom duty, etc. Now, taxes. Taxes represents a significant component of governmental cost impact. They are not only direct financial implications, but businesses, but also carry out costs related to taxation, administration, compliance, and reporting. Taxation details. Tax administration cost. The administration involves the process of expenses associated with managing tax-related matters, businesses, and then it could allocate resources for record keeping, reporting, and complaints to meet their tax obligations. And effective versus marginal tax rates. Understanding the difference between cost tax rates, the percentage of total taxable income paid in the taxes, and the marginal tax rates, the tax rate applied to the next dollar to taxable income, is crucial for financial decision making. These rates play a pivotal role in assessing the tax impact of additional income or income reductions. Investment tax credits. Encouraging investments. As part of economic policy, governments may offer investment tax credits to businesses. These credits serve as incentives to encourage investments in specific locations or industries, thereby promoting economic activity and growth. Few of the samples here directly shown investment tax credit. Government chosen to provide an investment tax credit only in key investment areas, allows business to deduct tax from the part of their income which is investment related. Credits are given in addition to the allowances given for the depreciation. Depreciation and depletion. Spreading cost over time. Governments employ mechanisms like depreciation and depletion to incentivize businesses to invest in assets and natural resources. Depreciation allows businesses to spend the cost of assets over time, reducing taxable income. Depletion serves as a similar purposes, but applies to the gradual consumptions of natural resources. Here, there is a small sample. Depreciation, wear and tear of a physical asset, like equipment and all. Depletion, exhaustion of the supply of a natural resources, coal mine, etc. Amortization, extinction of an intangible asset, patent, getting the patent rights. cost versus accounting cost, a broader concept. Economic cost represents a broader concept compared to accounting cost. While accounting cost primarily focus on monetary transactions, economic cost includes the notions of opportunity cost. The potential benefits of foregone when selecting one option over another. It transcends the confines of purely financial transactions. Here the picture representing the same cost in economics versus cost in accounting, how the implications are showcased here. Explicit cost and the implicit cost. Because of the implicit cost, implicit financial cost and opportunity cost, and the implicit non-financial cost. Cost is further go into opportunity cost. So this all the data has taken from some of the historical references. Okay. In summary, a profound understanding of economic cost is essential for making well-informed decisions across the various domains, including project management, cost analysis, and financial planning. If you have any questions, you can reach me or this given email ID.